Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, December 7th, 2023. As always, we'll start with the executive summary from our leadoff morning note. As always, if you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So number one, in a semi-annual testimony to the Japanese parliament, BOJ Governor Kazuo Ueda remarked that monetary policy would get tougher from the end of the year, triggering speculation in financial markets that the BOJ is setting up to incrementally tighten monetary policy in the months ahead. Ueda's remarks followed yesterday's hawkish commentary from BOJ Deputy Governor Rizuyo, my apologies on this pronunciation here, but Rizuyo Himino, which suggested higher borrowing costs may be getting closer. He also downplayed the negative impacts of a rate hike. Number two, these hawkish comments are coming at an awkward time for the Japanese economy. Per the 42 Macro Global Liquidity Monitor, the Japanese economy has among the worst growth dynamics among major economies. And lastly, number three, with growth and inflation momentum conspicuously slowing, we view the BOJ's recent hawkish commentary as merely opportunistic rather than strategic. Specifically, it's more likely the case that Ueda and his colleagues at the BOJ are reacting to the bearish VAM's breakdowns across sovereign debt yield curves of peer economies and sensing an opportunity to normalize monetary policy with minimal market impact. Any incremental policy tightening by the BOJ would likely contribute to global fixed income volatility, but at least they're being smart about when such yield curve control tweaks occur. So again, they're not trying to add to market volatility. They obviously would like to normalize policy, but they're going to do so in a way that obviously minimizes that impact. So at the margin, that's positive, but obviously in absolute terms, it's BOJ tightening policy is not a good thing. In terms of our global our 42 macro dashboard here this morning, we'll start with signals from our friends over at Longbow. Still getting some oversold signals in the commodity space right now. You got DBA, that's agriculture, that's oversold. You got crude oil, that's oversold as well. That downside in the range is opening up. So this is something that's starting to look like a crash here. So obviously, if you're short, it'd be a good spot to be lightening up. It's certainly not a good spot to be buying, given the bearish short-term and medium-term momentum that we're observing in that particular exposure. Base metals are also oversold as well, but again, that downside in that range is very much opening up, and so definitely, the commodities market is certainly sensing something. There's a real deflationary impulse right now. In the commodities market. Perhaps it's a leading indicator of something more deleterious from a global economic perspective. We don't necessarily buy that at the current juncture, just given the current top-down, the risk-on top-down market regime. If that were to change to a risk-off top-down market regime, then in our opinion, we would be starting to sense that something more deleterious is on the horizon. But again, it doesn't pay us to predict the predictors. We don't get paid to predict the predictors. We get paid to react to the predictors, and we're doing a hell of a job helping you do so as well. In terms of the 42 Macro Aware community, got a question here. I thought it was really interesting. Not really a question for in terms of what to actually do in terms of your portfolio, but I thought it was a really interesting question just in terms of like thinking about the world heading into 2024, given the policy divergence we continue to observe with some of these major central banks, i.e. the BOJ relative to the Fed and the ECB. So the question is asking, isn't it kind of lame for big central bank chiefs to have markets dictate to them their expectations and watch their main policy tool, which is interest rates, get basically stolen from them? They must have an urge to throw cold water on this out of just pride and a sense of power. What's your gut feel on this? So I'll start by saying I don't have any gut feels about anything, certainly none that I feel comfortable sharing. We are very systematic research and risk management, investors here at 42 Macro, and we espouse those beliefs onto our community, and rightfully so. We're continuing to show consistent outperformance relative to our peers, really since the inception of our firm. So, but beyond just having gut feel or not having gut feel, I do think it's very important that that central banks have had a lot of egg on their face, particularly here in the U.S. And Europe, where transitory was kind of the general consensus among central bankers throughout that entire time, particularly here in the U.S., where the Fed was a willing participant in the massive debt monetization scheme that we saw in 2020 and 2021. So in our opinion, we've seen this several times before, where Jay Powell comes out and tries to talk hawkishly in the face of easing monetary conditions, and the markets really do very little to support him on that. In our opinion, they backed themselves into this corner. And the reason I say that is because they are telling us that they are data dependent, And the data is really what's driving their monetary policy making decisions. And as we talked about a couple of weeks ago on the macro scouting report, post the PC report, it's very clear that we're observing a tremendous amount of immaculate disinflation in the U.S. economy. We talked about that in the PPI report a few weeks prior to that. Talked about that at the non-farm productivity number we got at the beginning of November when we called for the paying trade higher in terms of soft landing trades. And so, in our opinion, I don't think that they can do anything about this egg that they put on their faces, because again, they're the ones who put it on their faces. So I don't know if there's anything to do about this in portfolio construction terms or asset allocation terms or risk management terms broadly, but I think it's a good question to start thinking about how, markets may continue to evolve in a way that sort of makes central bankers and their words less important and ultimately makes the data more important. So in our opinion, I think it's probably a good thing for the economy and for markets, but who cares what I think if it's not about making and saving money in financial markets. So we'll let you go there. Darius Dale presenting our macro minute today for Thursday, December 7th, 2023. As always, we'll catch everyone have a wonderful day. We'll catch you back here tomorrow, and we'll have our macro scouting report out for macro scouting report subs and our purple subs this tomorrow afternoon. So looking forward to that as always. Cheers.